Let me start with a simple question. If an earthquake damaged your home tonight, do you know how much you'd actually have to pay out of pocket? Most people think they do because they're applying how homeowners insurance actually works. You have a deductible, insurance steps in, and that's the framework we're all familiar with. But earthquakes don't necessarily follow that framework by default. Earthquake coverage is not automatically included in a standard homeowner's insurance policy. Sometimes it's added as an endorsement to the homeowner's policy, while other times it's written as a completely separate standalone policy. But either way, if earthquake coverage isn't specifically included, homeowners insurance generally pays nothing for earthquake damage. So if an earthquake happens and you don't have that earthquake coverage on either your homeowner's policy or a standalone policy, there isn't really a deductible conversation to have. You're responsible for the entire loss. With that clear, the earthquake deductible conversation actually matters. So here's where most of the confusion starts. When you hear the word deductible, you probably think of a flat dollar amount. One number, one time, per claim. That mental model works well for auto insurance and homeowners insurance. Earthquake deductibles are just different. They're usually expressed as a percentage, 10%, 15%, sometimes higher. And the most important question at that point is simple. 10% of what? The answer is 10% of the coverage limit, not 10% of the damage. That distinction matters. So let's walk through one clear example. Let's say your earthquake coverage includes $400,000 of dwelling coverage, $40,000 of coverage for a detached structure, and $50,000 of personal property coverage. And let's say the earthquake deductible is 10%, applied separately to each coverage. Here's how that works. The dwelling is 10% of $400,000, which is $40,000. The detached structure deductible is 10% of $40,000, which is $4,000. The personal property deductible is 10% of $50,000, which is $5,000. Now, here's the key clarification. There is not one single $49,000 deductible, even though they may add up to that. There are three separate deductibles, each tied to a different coverage, and they can all apply in the same earthquake event if that one earthquake damages all three areas. So, if the dwelling, the detached structure, and personal property are all damaged by the same earthquake, your total out-of-pocket deductible for that single event would be $40,000 plus $4,000 plus $5,000. That's $49,000 total across three deductibles. The $49,000 is the total you'd have to absorb across those three coverages before earthquake insurance starts paying on any of them. Those deductible amounts are not compared to individual repair bills. They're applied to the overall coverage loss for each coverage. So, if the coverage dwelling damage came in at $30,000 and your dwelling deductible is $40,000, if your dwelling deductible is $40,000, earthquake coverage wouldn't pay on the dwelling portion because the loss didn't exceed the dwelling deductible. And if the coverage dwelling damage came in at $150,000 and your dwelling deductible is $40,000, then coverage would start paying on the portion above that $40,000. That's why earthquake insurance is not designed for moderate damage. It's designed for severe damage. Earthquake coverage is catastrophic coverage. It's meant for situations where the structure of the home is seriously compromised, where rebuilding is required, or where the financial impact would otherwise be overwhelming. That structure percentage deductible is often applied for coverage. It exists because earthquake losses tend to be infrequent but severe, and they can affect many properties at the same time. Now, let's pause and answer the honest question that usually comes up here. If the deductible can be $49,000, why have earthquake insurance at all? The answer isn't found by comparing premiums, it's found by comparing outcomes. Without earthquake coverage, a major earthquake means rebuilding costs, debris removal, engineering, and temporary housing are entirely your responsibility. A standard homeowners policy doesn't step in for earthquake damage unless coverage was added. With earthquake coverage, you absorb the deductible amounts, and once those thresholds are crossed, the policy can respond beyond that point. The deductible doesn't make earthquake insurance pointless. It defines where the insurer's responsibility begins. Now, let's talk about renters for a moment, because this same concept applies, just with smaller numbers. Imagine you're a renter with earthquake coverage for personal property only, and your personal property limit is $50,000. Let's say the earthquake deductible is 10%. 10% of $50,000 is $5,000. That means if an earthquake damages your belongings, you're responsible for the first $5,000 of covered personal property loss before earthquake coverage pays anything. If the damage to your belongings is $3,000, coverage doesn't pay. If the damage is $20,000, coverage can pay the portion above $5,000. Same structure, same math, just one coverage instead of several in the renter's earthquake coverage example. Just like with homeowners, earthquake coverage for renters is designed for serious loss, not minor damage. One more practical point that matters, whether you're a homeowner or a renter, even with earthquake coverage, cash flow matters. After an earthquake, expenses do not arrive in a clean sequence. Temporary housing may be needed immediately. Inspections or assessments may come before repairs. Contractors don't wait for claims to finalize. So the deductible isn't the only reason you might spend money early. That's why earthquake coverage works best as part of a broader plan: savings, access to credit, and flexibility. Insurance is there to prevent the big financial cliff. It doesn't eliminate the messy middle. Now, when it comes to choosing a deductible, lower percentages usually mean higher premiums, and higher percentages usually mean lower premiums. What matters most isn't just which quote looks cheaper. What matters is whether you could realistically fund the deductible if you ever needed to. A deductible that looks fine on paper doesn't help much if there's no real plan for where that money would come from. The deductible that tends to work best is the one you could actually handle if something happened tomorrow. So if you take nothing else from this video, take this: earthquake coverage may be added as an endorsement or written as a separate standalone policy, but either way, earthquake deductibles are usually a percentage of the coverage limits, and they can apply separately to different coverage buckets in the same event. Once you translate that percentage into real dollar amounts and understand how it applies, the policy stops feeling confusing and starts feeling predictable. If this was helpful, click like and subscribe. I put out videos like this regularly, straightforward explanations of insurance topics that usually don't get explained very clearly. And if you're unsure how earthquake deductibles apply to your own policy, that's a conversation worth having now, not after the ground moves. Thanks for watching.